Okay, if you viewed the sales discount video that I taped, you'll notice that this journal entry is the same from that one. So we're continuing on now with sales, returns, and allowance. So here's our original entry on May 5th. We had sales of $800, so it was on credit, so we're gonna debit accounts receivable, the asset, credit sales, the revenue account, debit our expense account, cost of goods sold, COGS, COGS, or cost of goods sold, for 600, and then credit the inventory, which is an asset account, for 600 because we're selling the items. So we have to take it out of inventory and expense that dollar amount, okay? Now, we're gonna look at a sales return. Let's say that this customer that purchased from us on credit doesn't need all this and decides to return half of it, okay? So they're returning half of these items that they purchased. So then let's say, we'll just assume that this took place on May 5th. So we have to reverse out all of these entries. Well, we have a new account though. We don't just reverse it out of sales. We go to sales, returns, and allowances. Kind of a long account name. Sales, returns, and allowances. It's a contra sales or contra revenue account. So it offsets. So that we can see that we have the sale, but then this will reduce it by the amount that was returned in this case. So I said half of it was returned, so we're gonna debit that 400, and then we just credit the accounts receivable 400, okay? Because we have to eliminate the accounts receivable, so we're going to credit it 400. But they're only returning half of the items. And then we debit inventory because we're getting the inventory back, $300 worth, and then we have to eliminate the entry that we had put in cost of goods sold. So you can see that all we're doing is we're reversing this journal entry. Instead of cost of goods sold inventory, reversing it inventory cost of goods sold, the amount of the items that are being returned to us. So this is an example of a return. Okay, this is an example of a return. All right, now let's move on to an allowance. An allowance is when the customer isn't satisfied, isn't happy with the items for whatever reason. And they call us up and they say, look, it's defective, we're dissatisfied, whatever the reason. Well, you might not want to get the items back. You might say, you know what, if it comes back to us and there's a problem, I might have to do some work on it, I've got to have it shipped back to me. I would prefer them just to keep these items. So you might negotiate a reduction in price. So let's say you decide, look, how about if I reduce the price $100? Will you be happy and just keep the items? And they may say, sure, if you reduce the price $100, we'll do that. Well, then our entry is right here again. We have to reverse out part of this because they're not going to be paying us $800. They're only going to be paying us $700 now. So we have to reduce that accounts receivable by $100. Well, we're going to use the same contra asset account and contra revenue account that we used before. Sales return, I'm going to abbreviate this time, RNA. Sales return and allowance for 100 because that's the amount we're reducing it by. And then we're going to reduce the accounts receivable, like I said, for $100. Okay, so this entry here is an example of an allowance, which is we're reducing the price of the item for our customer by $100. Okay, so our sales amount then is 800 still, but we have a sales, returns, and allowance of 100, so it reduces our sales by 700, because this sales, this credit, will be reduced by this debit of $100. So our net sales is 700, and then our cost of goods sold minus cost of goods sold, because that's an expense. So we have on this transaction $100 profit. Now if they have a discount later, that would reduce our profit even more. Okay, and we've already gone over how you do discounts. If there were a discount, the discount wouldn't be on the $800, it would only be on the 700 because we had a sales, returns, and allowance where we reduced the accounts receivable by 100. So the discount would only be on the $700. All right, I hope this makes sense. I know there's a lot in this chapter, but you really got to make sure you understand the purchase side and the sales side. When you're purchasing, discounts are done one way, using different accounts, than when it's a sales. With sales, we have the sales, returns, and allowance account that we need to be familiar with. All right, well, good luck with these videos. Hopefully these make sense and they're helping out. You probably need to view these videos several times because this isn't something that just comes automatically in your brain. You've got to really think about it and apply it and go over these transactions and make sure they're really making sense to you. All right, good luck.